For more on what we heard from the Federal Reserve already today, 3 rate cuts forecast for 2024, what this means for investors. Let's get to Michael Kushma, Morgan Stanley Investment Management CIO and Broad Markets Fixed Income Head. Good to see you, Michael. Thanks so much for being here. So, sort of first blush reaction here. Do you think that the Fed is managing the market's expectations appropriately?
I think they're doing a good job of steadying the ship, that there's no change in their long-term views about inflation, which has been underperforming or too high in recent months relative to what people thought is more a blip. It's more an outlier because their 2025 forecast, they will be at where they thought they'd be three months ago. So no change in their long-term view that disinflationary process is on track. They do not have to adjust monetary policy in any significant way this year in order to achieve those targets. So it's steady as she goes. There's no reason to think that we're not going to achieve our objectives. So in that sense, steadies the market. There's no surprises. Everything's okay, in a sense, on track.
Michael, they did, just looking at the projections here for core inflation, that did tick up a bit here, 2.6%. I'm just interested, when you look across 2024, the trajectory of inflation, what does it look like to you, Michael?
Well, I think they were realistic in terms of marking up a bit because the first quarter of this year has been quite disappointing. I think core PCE was up 0.4% January and February, and that is way too high to achieve that low 2 number at the end of the year. So I think that they've bought into the idea that this is more of a blip. But when we return to that disinflationary process we saw in the fourth quarter of last year, we were ticking along at almost below target, a 1.6% annualized rate. Now we've accelerated higher. If you look at sort of a moving average or trend of that, it still looks down. I did think it was interesting that they took out a rate cut in 2025, that the terminal rate for 25 for Fed funds is a little bit higher than it was before. I think acknowledging the fact that growth is stronger than expected. They've upgraded their growth forecasts across the board, and raising the long-term equilibrium Fed funds rate is reasonable given the growth of the economy has more potential than expected.
So, Michael, how do they make the argument that they should be cutting with the inflation projection still at 2.6%?
I think it's the trend in the economy. If you look at sort of models that people have typically used to think about how the Fed sets interest rates, there are things called Taylor rules. We look at the relationship of unemployment to full employment, the relation of inflation to target inflation. Those models all suggest that the Fed should be cutting interest rates a bit this year. Is it 3 cuts? Is it 2 cuts? But rates are probably high enough or even too high to achieve that objective over time. In other words, if they didn't cut 3 times, inflation may be too low down the road. In other words, they have to keep adjusting the Fed funds rate down as inflation continues to drift lower. Otherwise, policy passively tightens over time. So I think that's kind of what they're saying. Policy is more than sufficiently tight right now. Models would suggest it can ease at the margins, but no big time easing anytime soon. It's more of a glide path than any aggressive abruptness in terms of rate cuts.
Michael, I'm looking at the yield on the 10-year at 4.29. Michael, curious where you see that headed in the sort of the near to intermediate term here.
It's pretty tough for it to move much any which direction from current levels. If the Fed continues to cut rates, begins to cut rates as expected, Fed funds rates gets down to 4 and something, but the 10-year is 4.29. Shouldn't the yield curve be positively sloped with long-term yields higher than short-term yields? And right now, it's difficult to see that given the trajectory of monetary policy or Fed funds rate that we're looking at. So I think the 10-year yield is stuck somewhere between the very high 3s, 3.8, 4.3, where we are. It may not go a whole lot higher if inflation continues to get better. But as we heard from earlier, inflation has to get better. Q1 inflation's negative surprises have to go away, and we have to resume that 0.2% per monthly numbers for core PC pretty quickly. Otherwise, the year-end number will be in jeopardy.
Michael, you mentioned the yield curve inversion, but at least between the 10s and 2s that we continue to see. Is that just broken as a predictor of recession? Should we just not pay attention to it anymore? I mean, it's been inverted for a while now.
For a very long time. It's one of the longest periods of inversion we've seen. I think it reflects a couple of factors. One is the temporariness of most of the inflation shock. It is going away. It's taking time, and people are confident that inflation will drop to lower levels. It also reflects that the attractiveness of bonds at current levels is pretty good. The real interest rates, as indicated by the TIPS market, is almost 2%, and a 2% real rate of return on a U.S. Treasury security is very attractive by historical standards. So that absolute level of long-term yields looks pretty attractive to longer-term investors who are looking through the last couple of months or the next couple of months and say, yeah, I can get more yield in 2 years, but why not lock in these higher yields? I don't know how long they'll last at current levels. Plus, we do know the Fed has done a lot of QE over the last couple of years, and that in theory should be suppressing risk premium, term premium, and suppressing long-term yields relative to short-term yields. That should put some upward pressure medium term as QT continues to unfold.
Michael, I'm interested for fixed income investors who are listening right now. What are the areas you would guide them to avoid right here?
Well, I think to avoid being too bullish on bonds, expecting some big drop in interest rates. The economy is doing just fine. Things are ticking along. Don't expect any major economic downturn such that we'll have a major bond rally, from 4.3% all the way down to 3% at any point in the future. And that while risk assets, particularly stuff that we look at in terms of the credit markets, investment grade credit, high yield credit, seem pretty well supported moving into a Fed rate cutting cycle when the economy is doing just fine. So the Fed's cutting rates not because the growth needs it, just reflecting the fact that inflation is headed towards the target of where it needs to be. And that should be very supportive of risk assets in the economy. So don't get too bearish on risk assets. Don't get too bullish on interest rates.
At the same time, Michael, we've talked to some investors who have also said, the money market flood that we've seen, the money into money markets because of the yields there, should start to reverse. The people should start looking to the more risky areas of the market. But as the Fed pushes it off and pushes it off and pushes it off in terms of rate cut, are we going to see those flows actually be more persistent, perhaps?
It's certainly possible. I think that a lot of retail investors, myself included, look at what do I get for extending maturity, out of money market instruments or very short date instruments out the yield curve. And if you don't get paid a reasonable extra premium, why should I bother? Unless I'm trying to lock in a long-term attractive absolute yield, saying, I don't know when the Fed's going to cut rates. I don't know when yields are going to come down. But if I lock in these yields today, longer term, it looks pretty good. So pension funds, insurance companies, liability managers would look at the level of Treasury yields and investment grade yields in sort of the 10-year and longer sector. Look, the 5.5% corporate bond yields look pretty attractive from a longer term perspective. So I think there will continue to be a trickle of money out, but I think that it will not see a big reversal until we get a reversal of the inversion of the yield curve.
Michael, it is always great to have you on the show today. Thanks so much for joining us.
Welcome.